Warren William here for Smartest Data, looking at the forthcoming weeks and the key issues that could move the US stock markets. Rising interest rates, high inflation, combined with economic growth remaining resilient, are providing an interesting backdrop for US stocks. As we all know, 2022 has been a difficult year for the stock markets. But what does this mean for the longer-term outlook for the stock markets towards the end of 2024? Remember, the stock markets are very forward-looking. So in this video, I will look at these three issues: possible recession, higher interest rates and inflation, and how this is not necessarily bad for the US stocks in the longer term and could even plant the seeds for the next bull market. Then at the end of the video, I will discuss the 3 points which could indicate when the US stock markets could be on the verge of a new bull market. Let's go to the video and investigate. Okay, starting with economic data over the next week, employment and inflation will be centre stage. Tomorrow, Thursday, initial jobless claims around 230,000, while Friday, producer price index will come out. Then move into next week, the key data will be the CPI data. Year on year is expected to be running around about 7.8%. Then next Wednesday, the FOMC meets at the Federal Reserve and the Fed funds rate will be announced. The range is expected to be from 3.75 to 4%. Then later in the week, there'll be retail sales, employment data, industrial production index, capacity utilisation. Remember, the Fed will have confirmation of some or all of these data points going into the Fed meeting. Certainly dominating the direction of the stock market will be the forthcoming Federal Reserve's meeting on Wednesday as mentioned. The Fed is facing a real dilemma. The combined leading economic indicators, growth, inflation and employment are all indicating a resilient economy. Stubborn inflation and a stronger than expected job market are the hallmarks. A rate hike is expected at around about 50 basis points, or the hike could be up to 75. This is after 4 consecutive 75 basis points hikes in 2022. So stock investors are trying to understand how high the Fed funds rate will go. There have been mixed signals from the Fed, with Chairman Powell announcing last week that smaller rate increases are on the way. Certainly the tightening period is not over. Anyway, enough said of that, and now on to stocks. So the big question is the stage being set for the start of a new bull market in 2023? No doubt Q1 2023 will likely be a difficult earnings season, and lower earnings do not normally provide a foundation for higher stock prices. For sure, stocks are expected to remain highly volatile until the Fed stops raising rates. At this point, that expectation is around Q2 2023. I get it, but what we have to look for are the first signs of a bull market emerging. Be prepared for a scenario where stocks could rally in early 2023 based on earnings guidance. Then later in 2023, all going well, a new bull market could start to emerge. But why? Okay, so let's set the stage. Let's take a look at a roadmap of the economic cycle and sectors. Okay, here's my roadmap of the economic cycle and sector rotation. First off, I want to point out, you can see that the stock market anticipates the economy by quite a distance. Okay, so let's look at the top line in blue, the various sectors and the sectors which will outperform in which stage of the market. So we look on the left-hand side, banks, techs, consumer cyclicals. As we go through the trough, there's a low level of volatility. The equity market starts to pick up, and these are the stocks that starts to perform. Then, as we move into mid-phase in the bull market and mid-level of volatility, you can see tech, mining and industrial start to perform. Once we hit a peak of the market, so we're at the peak of the bull market, volatility starts to slow down. Consumer staples, mining and energy are the sectors which are outperforming at this point in time. Then as we move into the bear phase, volatility starts to pick up again as stock starts to fall down, and the sectors which will outperform at this point in time are energy, pharma and consumer staples. Then as we head towards the trough again, the sectors which start to outperform are financials, pharma and utilities. But as you can see, when the banks, techs, consumer cyclicals start to pick up and the market starts to pick up, we are still in a downturn phase in the economy. Whilst in the recession part, when the economy hits a recession, we're in mid-phase bull market, so the tech, mining and industrial stocks are starting to pick up. Then after that, once we're in the recovery phase, we've already hit the peak of the market. Once we're in a strong growth phase, the actual bear market is starting to form. Then once we're in a downturn, you can see that the market has already plateaued. Okay, so let me start to unpack everything that companies can benefit from the current triple whammy scenario: a possible recession, higher interest rates, and inflation. Okay, let's look at a recession first off. In the long run, a recession can actually be good for stocks. Quite provocative, but why? This tends to lead to a restructuring. Let me explain. Okay, so in 2022, the S&P 500 earnings ex-oil were down, I think, by a couple of percent, maybe 3 or 4%. The exact figure is not critical, but if you have the exact number, put in the comments below. But during a recession, companies can take advantage of the fact they have an excuse, tough environment, to restructure their businesses, cut excess employees. The bloated tech sector like Facebook, Google, and Twitter are doing just this. Various provisions are then taken against the P&L, and this can be used for any number of reasons. Further, devalue or sell off assets and take the loss against the P&L. In other words, clean it all up. The earnings can be driven down by many small and in very subtle ways, and this may be not even really understood by the broader market participants. Senior management and the CFOs understand that it is much better to do all this in a bear market when their share prices is down, as is the stock market. Done in a bull market could push the share price down, then who knows, the company could become part of a takeover. A lot of restructuring, reorganisation is done under the cover of a bear market. Higher interest rates. This actually pushes companies to restructure their assets as mentioned above, and also to reorganise their capital structure and deleverage. Look, low interest rates was kind of like free money. Debt at higher rates needs to be justified, and the question is asked, what is this debt actually funding? In the end, this helps return on assets, ROA, and if done correctly, will likely lead to a rebound in net earnings and EPS, then possibly, hopefully, lead to an expansion in the PE multiples. Let's move on to inflation. Rampant price instability, inflation or deflation, is very bad for the economy and for stocks. But this is not the current situation. Yes, inflation is at a 40-year high, but it's not rampant. But under the cover of inflation, being the level of inflation that currently exists, companies could develop some pricing power, which they did not have during a low inflation environment. So the current level of inflation is not great for investing, I know that, but it does provide companies with a degree of pricing power. Some inflation can be good for stocks, good for companies. In 2023, keep an eye on which sectors and companies have good sales growth. Okay, so is now the moment to buy stocks as a new bull market could emerge? Let's try to answer this question. As the stock market at the moment is in between earnings seasons and with the holiday season approaching, there is a slowdown. Okay, so let's go back to our roadmap, the economic cycle and sector, and apply that to data coming out of bar chart. So bar chart sets a heat map of the various levels of moving day from 5-day, 20-day, 50-day, 100-day, 150-day and 200-day moving averages, and the number of large cap stocks which are above those averages. Okay, so 5-day is a little bit too short term for me, but if we look at the 20-day, we see some interesting things. The market is still in a bottoming out phase. The financials, predominantly the banks, as we can see there, only 43% of banks are above their 20-day moving average. Okay, so what is performing? As we can see down the bottom, utilities 77% are still performing well, and then we move up and you can see consumer staples as well as healthcare. Consumer staples has 70% of large cap stocks above the 20-day moving average, whilst in the healthcare sector it's 72%. So how do we look at this? If we go back to the 50-day moving average, most are. So there is momentum behind the market, which starts to put our argument together that there is a bottoming out phase and the preparation for a bull market to start sometime in 2023. Now let's look to the Fed and the Fed's pivots, not a single pivot, but a series of 4 pivots, as it looks as if the Fed is on the verge of a policy shift. First, the Fed changes its vocabulary and rhetoric towards rising interest rates. Mixed so far, but it could possibly be more flexible, even more dovish. Second, it depends on the pace at which it could continue to raise rates. There are indications that the rate of raising rates could start to slow down. Third, the Fed could start to take a break from raising interest rates by the second half of 2023. Let's see. And fourth and finally, the Fed could begin to lower interest rates. Now, this is very unpredictable, but I'm sure it's a story for 2024 at least. And also remember, there is quantitative tightening going on. While at present there is an inversion in the yield curve is likely to steepen. But what about the possibility of a recession in 2023, which would undermine the stock market gains? The risk of recession certainly has not gone away, but the data does not support a pessimistic assessment at this point in time. Strong consumer spending and a booming labour market with payrolls rising 263,000 and unemployment rate holding at 3.7%. So let's hear what Jamie Dimon, the CEO of JP Morgan Chase, had to say yesterday.
But let's just start by saying the United States economy is the strongest economy in the world today. So we should celebrate that a little bit. And that's why capital's coming here, business is coming here, is still growing. If you look in the short run, the consumer is spending 10% more than last year and 40% more than pre-COVID.
Yes, the US stock market could be on the verge of a new bull market phase as a result of three things: company restructuring, the result of the Fed pivoting, and a stronger US economy. If this comes to pass, investing in the US stock markets could become very profitable. The key is understand your risk equation. No one else's, just your risk equation. Be prepared to stocks to rally early into 2023 on the back of earnings projections, then possibly pause. Then there's a real possibility that a new market could commence later in 2023. Be prepared.